I think we're on, Joe. Can you guys on YouTube hear us, and the guys in the meeting hear us as well? Okay. Are you there, Joe?
Yeah, I'm here.
All right, let's start it.
Cool. 7:30 Tuesday night, June 2nd, 7:30 Eastern. Thanks for having me, Frank. My name's Joe Fahmy. I'm here with Frank Zorrilla. We work portfolio managers at Zor Capital. We wanted to do this session just to walk you through a little bit of our process, take some questions, look at charts, what we're thinking about the markets. I hand it over to my co-host, Frank Zorrilla.
Well, right, look, we're gonna get started right away, Joe. And I have the privilege of actually seeing every day what it is that you do on a daily basis. And you've been hitting the ball out of the park. I mean, you've been seeing the ball really well for the most part for the entire year.
Thank you, man.
So,
Thank you.
yeah, I mean, we're not going to talk about numbers, but they're phenomenal numbers. So let's talk about what you're seeing right now in the market in general, the S&P 500, the NASDAQ, the Russell 2000.
Okay. Do you want me to pull up my my
Yes,
screen?
please.
Okay. So the main and thank you for that. I mean, I think the main thing and the lesson I've been tweeting about and talking about so much is to just shut out the news and pay attention to price. You know, I think that's the number one thing I do with my process is I've just accepted my opinion sucks, and most people's do. And I don't really want to have an opinion. I just know that the big institutions control the markets. I say that over and over and over, and I'll continue to say it because you have to hammer that into people's heads sometimes because they have too strong of an opinion on what they think the market should do instead of focusing on what it's actually doing. And one thing that's helped me is to just the first simple thing I recommend with people as part of their process is to get a chart book, look at the S&P. I like to use the NASDAQ because to me it is the go-to index for me, and it's a larger sampling of stocks, closer to 3,000 than 500 in the S&P. And just pay attention to distribution days and accumulation days. Pay attention to if we're in a trend, if we're above the 50-day. And pay attention to these big bars here. And the biggest takeaway currently in this market is we're just continuing to see all these big bars of accumulation with very little distribution in the markets. So that's what's telling me not to argue with the markets because the big institutions continue to not only support this market, but they're not really selling too much.
Okay, so here we are. We're up roughly 35% in the S&P 500 in the last couple of months.
Let me pull up the S&P.
Or the NASDAQ, same thing. They're both the same,
Thing. Yeah,
almost the same chart for the most part.
Yeah.
Right. So what do you say to the people who believe that we've gone, too quick, we're up too much, too quickly, and the world is coming to an end? What's going to make you cautious?
What makes me cautious is if I start to see distribution in the markets. So a series of, 4 to 6 distribution days in a 3 to 4 week period, because traditionally that's what marks tops or at least some intermediate term corrections in the markets. And 2, if the leaders, like Jesse Livermore says, so goes the market, so goes the leaders. So, and we can take a look at that in a second, but I want to pay attention. If the leaders start breaking down, then I'm going to be cautious. Your big cap liquid leaders, your Microsofts, your Apples, and all those, and Amazons, I want to pay attention to what they're doing. So it's not a matter of me turning cautious or me being bullish. I just want to stick with the trend until it proves me otherwise, which specifically is look for distribution and if the leaders break down.
And how quickly can that change?
It can change quickly. One thing I've noticed with this market, with just a lot of the, and we've talked about this, with a lot of the computerized trading and so forth, and you've talked about the CTAs that you follow. I mean, yes, it can happen quickly, but I still think the market gives you warnings. People who think, we're going to crash in a day, there's usually warning signs. when you look at the S&P, this crash in March, which I do call it a crash, they're warning signs, meaning big distribution as we see here, breaking below the 50-day, breaking below the 200-day. So there's warning signs. It just doesn't happen in one big day.
Okay. And what stocks are you, not that you own, but that you're watching? What are your leaders?
Well, the first thing, because I want people to get, and I'm sure you do too when you get into a little bit of your process, is I want people to get education from this. And I'll just tell you a very simple thing. When someone asks me about what I think of the market, or someone asks me what I think of a stock, the first thing I'm looking at is the 50-day moving average. If you get one lesson from this, and that's all you remember, is just plot a 50-day moving average and think of it as a red light and a green light with a traffic signal. If we're above the 50-day, for the most part, the stock and the market's going to be healthy. And if we're below it, be cautious, and it's probably not the best thing, and the reason for that is because the big institutions support around the 50-day for the intermediate term trend. So if we're below that, that's when I would get cautious.
Right. But I don't want people to get confused to the point where if a stock and the market is trading above the 50-day moving average and that one individual stock breaks down, are you selling, or you're saying, look, it's still above the 50-day, or the market is still above the 50-day, forget my stop, it's down 25%, no big deal?
Yeah, I mean, that's a great question. I mean, I think there's just a lot of nuances because I'm trading individual stocks. So I want the backdrop of the market, institutional support, and the markets being backed by the institutions. But, at the same time, I mean, you asked about some of the leaders. I'm going to default, because I've said this, 90% of what I judge the health of the market on is on the price action of the leaders. So I'm just going to mainly default to the stocks. So let's go through a couple of the fangs. I mean, Amazon, I think so goes Amazon, so goes the market and the economy right now. Because it's not just retail, but it's also Amazon Web Services, and a lot of people, that's where a lot of the growth is. I mean, they say Amazon Web Services is worth, close to half of the market cap if it's separated from Amazon. So, I mean, if they separated the companies. So anyways, I'm looking at these leaders. I'm looking at Microsoft, one of the largest market cap companies in the world. And as long as they're strong chart patterns and they're holding up well and the institutions aren't selling, these are the ones I'm paying the most attention to.
Right. So the FANG names: Facebook, Amazon, Netflix, Microsoft, Google.
Yeah. And a couple of the other ones that aren't in FANG. I mean, Microsoft and technically it's not in FANG, but I'm looking at MasterCard and Visa, PayPal, some of the big payment processors. I'm looking at some of the big medical names as well. I like to look at the big caps, because right now, when you talked about, the difference right now between the NASDAQ and the S&P is there's about 6 of the 11 sectors in the S&P are unfortunately lagging and hurting from what's going on. But unfortunately, just the way it is, there are some sectors that are benefiting and thriving through this, specifically in software and other sectors. So I think that's why the NASDAQ's held up better. And that's because of those big liquid leaders. So you might as well pay attention to those. And even if you don't own them, pull them up every night and go through them and take a look at some of these charts. And as long as they're in good uptrends, then I'm not going to argue with the market.
Right. No, there's no doubt about that. I mean, I usually go to TradingView and I put all the FANG names: Facebook, Amazon, Apple, Netflix, into one, and look at that chart. And as long as that is actually doing okay, then we're usually fine. If I can bring this up.
Yeah. So you have a chart of just the FANG. It's one chart of the FANG.
Just the FANG. Just give me a second so I can bring this up so you guys can see it.
Yeah, go ahead.
And
guys, please keep bear with us because we're doing this live, so we're doing our best.
Right. So here's Facebook, Apple, Amazon, Netflix, Google, Microsoft, NVIDIA. And basically what you're saying, as long as these things are holding up well, the institutions are there. I don't think that you can worry too much about the overall market unless these things unless these stocks start to roll over.
Yeah, I think they go hand in hand. I think if they start to roll over, of course, it would make sense that the market's going to roll over as well. you know?
Right. To your point.
Yeah.
So
Now,
go ahead.
you're very disciplined with your entries, and that's one thing I really admire. I wanted to, people to for you to share a little bit of your process, because I know we both do screening and stuff like that. And while you have the, TC 2000, is that one of the main things you use for your screening?
This is the main one that I use for my screening. Yes.
Okay. Yeah. Maybe if you don't mind, just, because we're trying to educate and hopefully people get some takeaways from this. I don't know, maybe go through, some like one of the simple things you do as part of your daily routine.
Right. So first and foremost, I'm a firm believer that we don't trade the markets. We trade our beliefs about the market. So, depending on when you started, if you started during a bear market, you probably think that every correction is going to be a bear market. Uh, you know,
No, that's
if,
true. That's a great point. That's a great point.
if your first book was whatever it is, how to buy penny stocks, you're probably going to be a penny stock guy. So I think for the most part, we don't trade the market. We trade our beliefs about the market, which is important. And it doesn't mean that someone's right, someone is wrong, because at the end of the day, we can all do different things. What matters the most is execution. If we can't execute, nothing matters at all. Joe,
Yeah.
you can give all your secrets and all your whatever your daily watch list every day. It doesn't mean that people are going to be able to execute the way you execute. I mean, there's a mental game here that that people have to learn,
Yeah.
the mental game of the market, and I think that's very important. What I do on a daily basis, my beliefs might be a little different than yours, but what I'm interested in is the execution. That's what matters to me the most. Okay.
Okay.
So when I start my mornings, I am usually going through a couple of scans that for me are based on market structure. So I might look at the top momentum names on a 3-month basis, 6-month basis, and a 1-year basis. The top 200 names of each one. Now,
Okay.
some of these names, typically, they're not widely known names, but I think that you can find some decent winners going forward. And here's what I mean. So I'm going to do this. I'm going to go to recent performance across the board. I'm going to go start with the best performance stocks on a 3-month basis. All these stocks are trading above $2 a share. And what I'm looking for is something like this. A stock that was not very well known, didn't trade much volume, and then suddenly news comes out for whatever reason. This stock now here trades 101 million shares. On
Okay.
this day, it trades 164 million shares. So that's tremendous volume, not just for this stock, but for any stock. And then what I'm looking for is this type of consolidation here. So I have no interest in trying to get involved in the first leg higher. I want to get involved in this second leg higher.
Okay.
So that's typically what I do. So I'm going to go through the top 100 names on a 3 months, 6 months, and a 1-year basis, a year to date. And here's this very similar situation where this stock, for some reason, traded 100 million shares. And then what I'm doing is I'm waiting for the consolidation to happen. And as you can see here, I got involved right over here. This one didn't do much, but this is exactly what I'm doing on a daily basis.
Okay. Yeah, I think we have a similar process, and I'm just trying to pull up what before I forget, because there's a great chart here. I mean, we're the similar process is we're looking for consolidations to buy off of.
Right.
And so I agree with you to ignore. It's okay if you miss part of the move, but it's actually nice to see that move before that. Let me see if I can find this chart I was going to pull up. But you can keep talking. I was just going to pull up a chart of something if you want to. Oh, here it is. So let me see if I can find it. And we're going to copy this over. And I want to share this because I want to just sort of, it kind of summarizes a little bit about what we do with, here we go. Sorry. Again, you just reminded me of something. That's why I'm pulling this up. Here we go. So this is cup with handle. And I think this is a very great pattern that both of us, if everyone can see it, hopefully, yeah, there we go. That both of us trade very similar type of pattern where, you get you basically, that's why I thought of this chart, because you basically said it's okay if you ignore that uptrend that's on big volume, let a consolidation come and wait for a compression and, some volatility, some, some tightness in the pattern, because the key isn't to buy something at $30 and then, you're buried at 20. It'd be nice if you bought it at 30 and within a couple of days to be at 31, 32, 33. So you have a little bit of a cushion and you're building confidence rather than being buried in a stock and just, now you're listening to conference calls and you don't know what to do.
Right. And
So,
I think it's important to understand. I'll just talk about my time frame and
sure.
what I am looking to get out of these trades. So let me go back and share my screen, which is important because if you have different time frames, let me see if am I back here? New share,
Yep.
share. Okay, if you have different time frames, different things matter. So what I'm looking to accomplish is I'm looking to catch a burst like this, where it might last 4 to 5 days. And
Okay.
within that burst, depending on market conditions, you might get a 15 to 20% move, depending on how, how large the float is. Here's a perfect example, Caper. This is a stock that, again, similar to the other ones, here is trading 200,000 shares. And then suddenly news comes out about COVID-19 that trades 198 million shares. Okay, this is big volume. This is game-changing news that happened. And what typically happens is that if you're a day trader, you can get involved in this very first day, right?
Yeah.
No problem. But you normally get the secondary offering, they raise money, but then you get some type of consolidation. At the end of the consolidation, you see the tightness, not only in the price action, but also in the volume where it's
In the volume
almost
as well. Yeah, that's a
nothing at
great point.
all.
That's a great point.
And then for me, this will be my trigger going through this single high over here. Like here, 511 long, 725, inside day through the high on the lowest volume. Now, this doesn't seem like a big move, but this stock went from 7.25 to roughly 930 the following day.
Oh, percentage-wise, that's huge.
It's huge, right? So
Yeah.
it's important to understand what it is that I'm looking for with my swing trades. My time frame is anywhere between 0 to 5 days. I am looking for anywhere between a 5 to 20% move within that time frame. Now, if you have a longer time frame, entries won't matter as much.
Agree.
And different things might matter. If you're looking to hold on to a stock for the long term, number one, you have to make sure there's something behind that. You need numbers, you need sales, you need a story.
Yeah.
Number two, and more importantly, you need a wide stop, in my opinion, because you typically have two type of stops, Joe. You have a tight stop where your risk reward ratio would look really nice if the stock goes up immediately, but then you might get stopped out a lot because you have such a tight stop. And some
Okay.
people can't handle those type of stops. So you need to know yourself and what it is that you can handle. If you can't handle tight stops where you buy something today and then you have to get rid of it tomorrow because it went against you, then my suggestion would be that when you get involved with something that has a story, you like the numbers, you like the idea, that you start with a 20 to 25% stop. That's going to give the stock some wiggle room, to move around, and you won't be stopped out within the noise.
Right. No, that's a great point. And just to kind of correct what I said, when you said if you're holding longer term, your entry doesn't matter, I think the key is as much,
Right.
meaning you can still use these patterns to buy longer term, but you don't have to be as specific and precise as you are. You're a pro and you're on top of this and laser focused every day with these things. But if you get a general pattern with a stock, and let's say it's a $90 stock, you think it's going to go to 150, okay? It doesn't matter if you buy it at 88, 90, 92, as long as it's somewhere in that range. But so I agree with what you're saying, longer term, it doesn't have to be super, super specific. But for what you're doing for these, short bursts that you're great at identifying, it really does matter because you're just looking to take advantage of a volume burst in a stock for a swing trade.
Right. Let me just say, Joe, before we continue, that if you guys have any questions, put them on the chat and we'll try to get through as many questions as possible. Now, Joe, so how do you start your day?
A lot of bacon. No, I'm kidding. I actually do my work at night. I like to do it at night when I'm wait after the market, after I've had dinner, relaxed a little bit. So you kind of calm down. Some people do it in the morning. I like to do a lot of work on the weekends as well, because you get the full weekly volume for the week to compare. But, just to take you through really quick, let me go back to my MarketSmith screen. I mean, the first thing I want to look at is I want the trend of the market. It's not the most important thing, but why I pay attention to this is 4 out of 5 stocks move with the general direction of the market. So when the market's in a decent uptrend, like it has been, for the most part, 4 out of 5 stocks are going to move up. So your neighbor can give you a stock, your buddy can give you a stock. The market's in an uptrend, almost everything can go up. Now on the flip side, when the market's going down, 4 out of 5 stocks are going to go down. I don't care how great the company is. When the market's in a correction, almost everything gets obliterated. And a perfect example of that is when we had the financial crisis in 08 and 09, Apple was just starting to come out with 2 of the greatest products of our lifetime, the iPad and the iPhone. And Apple, again, split adjusted, still went from $220 down to like $60 or $70. So my point being that when the market's in a correction, they just get to everything. So to directly answer your question is, I just want to, how I start my process is I want to just make sure that the market is in a good uptrend, or at least is healthy, to give me the backdrop to say, now let me start digging into some stocks. And as I said, the Nasdaq's my go-to. I also like to look at the S&P 500 just to get a broader market view. I love looking at the Russell 2000. And the reason behind this is that it is an index of risk appetite. So if the institutions are putting money to work in the Russell, then that's a good sign that they're putting risk into the markets. So those are the main 3. I mean, yeah, you can look at, NASDAQ 100 and, NYC Composite, but those are the main 3 I'm looking at. How much do you do a lot of index work, or is it mostly do you go right for the stocks?
I go right for the stocks.
There's a lot to be said for that, because at the end of the day, I keep saying, 90% of the health is on the stock. So you're going right into that, and that's smart. I still want that backdrop of an uptrend in the markets.
Right. What it is that as far as I own the indices as core holdings, right? So I own the SPY, the Qs, and the IWM, and I own that forever. The only thing that changes is the allocation. So as we start going down, and the indices are at that, the average intra-year decline for the S&P 500 is roughly 15% in the last 30 years. So as we get down to that 15% level, my allocation to the indices is going to increase. And then as we get these huge pops, then I'm going to decrease some of that allocation, but I'm always going to keep a piece. As far as my swing trading is concerned, I put something on Twitter today about some of the lessons about the current market environment, what we learned over the last couple of months. Number 1 is that risk happens fast. We lost 30% in a matter of 30 days.
Right here, yeah.
Right. So number 2, now we're not only taking the elevator down, but we're also taking the elevator up. We're up 35% in a month and a half. We have 2 years worth of gains in a matter of 35 days as well, right? So risk on also happens pretty fast, and resistance and support for the most part have been meaningless over the last couple of months. We went straight down, right through support. We went straight up for the most part, right through resistance.
People said 2,500, 27, no way, 50-day, no way, 200-day, no way, 3,000, no way.
Right.
I agree with you. It's a waste of time.
And more importantly, as swing traders with my time frame, we're always going to be better off worrying about the individual setups than the individual daily bars on the SPY and the IWM. So on any given day, I have no idea what the market is doing. So here, let me show you my screen.
Yeah, go ahead.
This is basically my main screen. And what's more important to me is my rolling 5-day watch list. So over here, 527, this is the names on my list that I have for that day for buying reasons. Like, ZNTL 527 was right over here. This was the inside day. The buy stop would have been through this high right over here, plus 10 cents. So this is what it is. And this tells me more about the market and the health of the market than me looking at the SPY, Qs, and IWM. Now, if we
Okay.
are in a correction like we were back in March, then that's a different story. If we're back in March and the market is going down, everything is going down with the market. Everything correlates to one. But right now, when we're pretty much trending and we're doing okay, my rolling 5-day watch list tells me a lot more. It tells me whether I should be holding on for bigger moves. Should I be selling a little bit sooner? Should I be getting more aggressive? It tells me everything I need to know for my time frame.
So you're basically, when you narrow your list down, you're watching those, the rolling 5-day lists, because it's telling you if they're working, the market's healthy, and if they're not, the market might need a breather. Or am I assuming too much?
Yeah, you're right. You're assuming too much. Right. Right. Look, there's certain times that I'm trafficking in the wrong stocks. Right. So the market could be doing extremely well, and maybe I'm looking at the wrong stocks. And that's happened over the last couple of.
That happens a lot.
Right.
Yeah, that happens a lot.
And that.
Sometimes the big caps are just leading, and sometimes,
Right.
yeah, and we're in some small mid cap names that might not be moving.
Right. And right now, with the market, normally when we get this type of move, this little piece right here, I don't do as well as you do in this little piece right over here.
I love sideways. So
Right.
that launch off the bottom where you talk about you want to own a little bit of the index, because I'm a growth manager. I'm not going to own, and you are too, you're looking for strong setups. I'm not going to own the airlines. I'm not going to own the hotel names and the travel names and the energy names and the financials that are all getting crushed. So I agree with you, off of the lows, because those moves can happen quickly. You grab maybe some of the ETFs, but going back to that SPY chart real quick, I'm going to do better in that consolidation. So I might not get that huge move off the low, but that sideways move, between 2,900, whatever that sideways move on the SPY correlates, that's when I do better, because the market digests, but individual stocks I find work out better.
Right, exactly, right. And that's where you get the outperformance. For me, right over here, when it gets a little extended based on the way I see things, because this is a thing that I can, like, for example, if you're in a baseball team and you can be the slugger, right? You're the cleanup hitter. And maybe you're not hitting the ball as well for a certain period. And maybe the guy who's batting number 7 or number 8 is seeing the ball well, and he's hitting the ball well. So there's certain times where I might not be in tune with the market. I'm looking at the wrong stocks, and that happens. And I think it's important for people to know that you can't go out there and change your strategy every time you go into some type of slump. But regardless of that, whatever it is that I believe here, that even if I believe the SPY is a little overextended, I am still going through my watch list, and I am still taking trades.
Okay. We got a quick question here. Someone's saying, Frank, is there any time when you stop searching for A+ setups? I mean, if, for example, the S&P is below the 20-day, do you stop trading, or is there any market timing you use to press the pedal to go slow?
Yeah.
Or press the pedal or go slow.
Right. So my rolling 5-day watch list will tell me that. Right.
Okay.
And then usually when the market is in a free fall, what typically happens is that I stop doing looking at individual names, and I'd rather trade the ETFs, because again, usually when you are in a deep correction, I'm not talking about 2-3% pullback. I'm talking about 15% plus, like we saw here.
Yeah.
And 9 out of 10 times you're better off just looking at the ETFs, because if you're looking for a market bounce when we are in a deep correction, there is no guarantee that individual name is going to bounce with the market, but there is a guarantee that if you buy the SPY, the market bounces, you're going to participate on the way up.
Yeah. And there's nothing wrong, and there's absolutely nothing wrong with that. I love that strategy, and something I've actually learned from you, as far as, it can be very effective.
And what usually happens is that I have my rolling 5-day watch list, and these things have to go through the previous day high for me to get involved. And what normally happens at the very end, right before we go into some type of pullback, I will have a list of stocks that are not triggering. I will have a list of stocks that go up for one day and then they all reverse. So these are some of the things that tell me that, to slow down. And if for some reason I have an opinion about the market and about what's going on, I don't impose that on the market by saying, hey, I'm going to short because the world's coming to an end. I might just reduce my size and let the market do whatever it is it's got to do.
Yeah, that's smart too. And that's something I encourage so many people, because there's so much fear. You talked earlier about the psychology. There's just so much fear with people trading, and there's so much doubt and so much questioning and all this stuff. And our job as traders is to build our confidence as best as possible. Because like you said, you could hand someone the greatest setup on a silver platter. You can give them all the tools and give them all the perfect books to read and all this stuff. If your head's not right, you're screwed.
Right.
And if you're trading from a position of fear, you're screwed. So one simple way to help with that fear is start small.
Start
Because
small.
people are like round numbers. Okay, I'm scared. I want to buy this. It's 100 shares and I'm scared. Okay, why is it an all or nothing thing if you normally buy 100 shares or you take a whatever 5% position, whatever it is? Why is it an all or nothing thing? Why can't you take 50 shares? Or why can't you take, if I say I'm normally going to buy a 2% position, why not take a 1% position? At least you're participating and you're working out with smaller weights. And then if you start to build that confidence, and hopefully you do, it makes your decision making stronger. And now you can lift heavier weights.
Right. Not only that, my recommendation to everyone now is that there are no commissions now. It's free. Okay. Years ago, when I started as a broker, the minimum commission was, I don't know, 100, 200. We were charging a quarter. We were marking up stocks 25 cents. So if you bought 1,000 shares, you would charge $250. Back then, the spreads were a quarter by three. It was 30 and a quarter
Oh
by
yeah,
30
yeah.
and
There was
3/8.
no pennies. Yeah, it was all
Right.
fractions. Yeah.
So my suggestion would you do one share and just get into the process of being able to pull the trigger when the stock triggers and sell it when you need to sell it. And do that over 25 trades and slowly but surely just increase the size until it becomes a process where the information, here's the problem. Most people take the market information as personal. If it goes up, they believe that information is good. If the trade goes against them, they believe that information is bad. And the market doesn't know who we are. The market doesn't know that I own XYZ and
No,
it
the
moved
market
down
it doesn't
20%.
care. It doesn't care either.
Right. So the point is not to take the information the market gives you as something personal. The market trades in a probable, and it's just a probable way. So you need to make sure that you understand that and accept that. Joe, here's a question for you.
Yeah.
Joe, can you please talk about the high tight flag patterns?
Okay. Let me see if I can pull up some examples. So let me pull up my Market Smith. It's a great question, and I'm a big fan of the pattern because it's where you can get some explosive moves out of them. I mean, the first one that comes to my mind historically is Qualcomm. Back in 1999, and essentially the pattern is when a stock. So all right, so the basic definition is the stock, and you can find this in William O'Neill's book, How to Make Money in Stocks. It's defined. The basic definition is a stock pretty much doubles in a short period of time, let's say 6 to 8 weeks, and then goes sideways for 3 to 5 weeks without more than a 20 to 25% correction. And some people are really, really strict with their numbers. That just, it corrected 26%. And just shut up about that stuff. It's like the basic concept is a stock goes up huge and then high tight flag, which is, just think about it. If you have a stock that goes from, in this example, goes from 50 to 100, and you're not taking profits and you're an institution, like, you and I are out of this stock well before that. But if we're not taking profits, why do you think if you're a Fidelity or T. Rowe Price or Vanguard and you're not taking profits, why do you think you're not taking profits? Because you're like, this thing's going higher.
Right.
So the concept of a high tight flag is a stock makes a huge move, not a normal 20% pop, the kind of stuff you're looking for, 10, 15, 20% off of these patterns, makes a huge move, goes sideways and barely gives anything back.
Right.
when you would expect intuitively people to take profits. So in the example of Qualcomm, and this is all, split adjusted or whatever, but went from roughly 50 to 100, barely gave anything back. And then when it emerges from that, you can see very, very sharp moves, 100, sometimes 200% in a few months in short periods of time.
Right. Okay. Right. And based on that definition, if you take a look at what I was showing earlier, I would argue it's almost the same thing. The only problem is that most of these stocks, they do go down more than 25%, which on that single part, I don't put too much weight behind that. If you look,
But real quick, the high tide flag is a very rare pattern. So it's rare to see a stock double in a short period of time and barely give anything back. So that's why I love finding them, because they're rare. But for the most part, you're right. You're going to get a breakout and get about 20% before a stock corrects, and 50% of them will come all the way back and retest the breakout.
right. So something like this that goes from 150 to 350 in a matter of a few days, would that be considered a high tide flag under your definition?
What part are we looking at? At that right there?
Right
Yeah,
here?
I mean, yeah, I see that. I mean, yeah, and it's gone up in a big surge and gone sideways. The basic premise behind it is, and that's why I was saying it's not to be. I'm not saying you. I'm saying a lot of people, they're obsessed with the definition. The
Right.
basic premise, whether you want to call it a bull flag, I know some people call that, is that a stock goes up and barely gives anything back. So let me, if you don't mind, I'm going to pull up,
Yep. Yep.
you know, um, some potential examples in this current market. And again, this is just for informational purposes, blah, 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 blah. So something like Fastly, this is an example in the current market, because people are like, great, show me Qualcomm from 99. I want something now. The stock went from 20 to 40 in a short period of time. It's not super, super perfect, but the concept is this thing has doubled and barely gave anything back. In addition, this is the PO is a they did a secondary with a whole bunch of shares that were absorbed by the institutions.
Yep.
So full disclosure, it's a position I own, but that's why I'm looking for something like this. Now, another example in the current markets could be potentially something like Twilio. I mean, the stock has gone from 100 to 200 and barely given anything back. It's not necessarily to identify a high tide flag. It's the concept of a stock makes a big move and barely gives anything back. You got to pay attention to that. And you're right, it might pull back, and it might pull back and retest its 50-day and pull back to 150, which would negate the high tide flag, but it would still be a hell of a move where it would have a normal pullback. But that's why you observe these things on a daily basis.
Right. And that's important, that the pullbacks are going to happen. And I think for most people, I think it would be extremely beneficial for them to start with wide stops.
I agree with that.
Um,
I agree with that. I mean, the perfect example, I mean, look, I'm just picking a big cap stock, something like Microsoft. This looks decent, as far as building a cup with handle. And, if you want to play this for a bigger move, I know it's a mega cap stock, but you got to give yourself, some people would keep a really, really tight stop and say, okay, I'm going to use today's low or the low of this range. If you think this is I know it just got upgraded, Wells Fargo, someone upgraded, let's just say hypothetically, today was upgraded with like a 245 price target. If you think it's going to go to 240, 250, you can't put a 180 stop on it.
no.
I mean, it's 185. You can't put a 1-2% stop on it. You probably want to give it, for a longer term holder, I don't know, maybe you want to, I don't know, not that we got this question, but maybe you want to, I don't know, 50-day or something as a close below the 50-day as a stop, something like
Right.
that.
And you can always tighten that stop up, and you can trail the stop as well as the stock starts to move higher. It doesn't have to be a stagnant stop.
Correct.
But I think the point is that in the beginning, it should be a wide stop. So that way you allow the stock to have a little wiggle room. And as it starts to trend higher, then you can make it tighter from 20% to 10% and so on and so on.
A perfect example, really quick, you just made me think of it, is Tesla ran up and it was starting to consolidate. And I don't know what day it's going to go. Nobody knows, but I just said if you gave yourself a little bit of room, because it's an $800 stock,
Right.
and while it's building this handle, if you had a $5 stop on this thing or $10, you're screwed.
Mm-hmm.
You're screwed. If you give yourself a little bit of room with some patience in a bull market, in a market when we're in an uptrend, obviously you don't want to do this in corrective markets, but if we have a good backdrop and the market's in an uptrend, you gave yourself a little bit of room, you know, you might have got a little bit of this breakout because again, if you had too tight of a stop and you didn't give it room, you would have missed it.
Right. I'm gonna answer this question here, Joe. I think I did already. It says, do you stop looking for A setups? No, I don't stop looking for setups, even when the market is in a correction. My expectation of the outcome of those setups might be different. Maybe I'm not looking for a tremendous move. If in the bull market within that little small 4 to 5 day burst, a small cap might give me anywhere between 5 to 25%, and the corrective market might only give me 10%. So I am not. I'm not when the market is in the correction. I'm still doing the same exact things because things can change quickly, and you want to
Okay.
be on top of it.
I agree. Someone in the chat is asking if you want to share what is a solid white line on Frank's TC2000 chart. I didn't notice if you want to go back and share your screen.
Yeah. No, that's.
You don't want to talk about it?
No. I don't want. You
Is
know what
that
it is?
proprietary?
No. You know what it is that there's a lot of things that don't matter that much, and this is one of them. Indicators, for the most part, they just don't matter.
Yeah. I mean, I'll tell you, like for me, I have on my charts, since it's up, the green line's a 20-day, the red line's a 50, and then the 200. And the reason is it's not an indicator. It's just sort of, you know, a nice reference point. I think Brian Shannon used the word reference point, and he's a great technician. And I agree, where in strong markets, strong stocks will hold their 20 days.
Right.
And intermediate time frame, you're going to get normal pullbacks to the 50-day. I know Netflix did that, maybe on some of the bigger cap names. You know, Netflix pulled back here after it broke out to the red line, the 50-day. And then the 200-day is, to me, my absolute line in the sand. I will almost never own something below the 200-day. Why? Because the greatest winners throughout history, 99% start above the 200-day. So you're really fighting most likely a lot of overhead resistance.
Right.
So that's why I have those averages up.
And that white line, which is this one in purple, talking about Brian Shannon, that is just the anchor VWAP.
Okay.
I think the anchor VWAP is something that is not widely used right now, but I think it's a great indicator. And typically, and because years ago, before there was a VWAP, when we had a tremendous big move on a stock, what people did, they wrote down the date and they wrote down the high and the low. And that actually, you know, those were the big numbers for that stock. That's, you know, if we break this, this is like, for example, the Lehman low. So that's important. So what I do is when I see a stock like this that traded 198 million shares, I just plot the VWAP, and it gives you pretty much the supply and demand of the stock since this day. And if you look at also many IPOs, you'll notice that many IPOs, if you plot the VWAP, the anchor VWAP from the first day, it kind of like acts as somewhat of support and resistance. And for example, talking about FSLY, here's that big update on news.
Are you sharing? You're not sharing your screen?
I'm sharing. Okay, so let me just show FSLY. Here's the big day.
The big earnings gap, yeah.
Right. It traded 18 million shares. Here's the VWAP from that day. And here it comes down, and then you get a quick bounce off of it.
The solid one is the anchored or the dotted?
The white one, this white one here.
White solid line, okay.
Right. So this white one here, what I have here is this is when the stock traded 3 times its usual volume and it was up for the day.
Okay.
So those days are important to me. Any stock that trades 3 times its average 20-day moving volume, it's important to me. That might mean something. So once that happens, I have a scan for that, and then I'm looking for a pattern, a tightness, a consolidation, whatever it is for me to get involved.
Okay. I'm trying to think of, let's see if we got any other questions here. Someone asked about when the market pulls back, what signs do you watch to find a bottom? That's a great question. I, I mean, it really depends if it's I mean, Frank, you made the point that, and I think people forget this, over the last 30 years, the market has averaged a 15% intra-year decline. So it depends if we're having an 8 to 12%, which is normal, or it depends if we have a bigger 20, 25, or in this case, 30 something for 32% on the S&P. What you want to look for is follow-through days, where you want to look for signs of, big prints of the institutions coming back into the markets. I think we had a couple of them here. We had another one somewhere in here as well. And then after that, very little distribution.
You gotta share your screen, Joe.
Oh, sorry. I did the same thing. I'm marking up my screen. Sorry about that. I know we're live, so thanks everyone for bearing with me. With something like the S&P, looking at let me reset the line just so I can show this. For a market to bottom, you need follow through days. You need signs of the big up days, 1-2% on big institutional days. And then what keeps me bullish from there is you get the snapback and you get a follow through day, which doesn't guarantee we've bottomed. Now, to your point, Frank, you may want to start looking for individual stocks after you're looking at the ETFs. But from here, the key is, okay, the selling is slowed down. You go from a red light to a yellow light, meaning, okay, I don't have to get super defensive, but maybe I can slowly dip my toe into the water. But the key is you don't want to see any heavy selling resume. And if you noticed, this is a 50-day, this red line here is a 50-day moving average of volume. Look at what happened when we consolidated this whole move from, let's say, 2,900 roughly. There was no volume. There was no volume, telling me the institutions, one, came back in, and this is when I really pay attention on a daily basis to accumulation and distribution. One, they came back in, but two, they're not giving anything back up. And
Right.
you tend to see that, to your point, Frank, with the individual stocks as well, where you're seeing these volume blasts and you're seeing sideways consolidation.
Right. And I think it's important, to people to realize that you can't avoid the unavoidable. You're going to have losses. So you got to stop going out there trying to find a strategy where you're not going to have drawdowns and you're not going to have bad months or 3 months or 6 months. You got to stop doing that because you cannot avoid losses. There are too many people who want to fine tune their strategy so they can be right every single time, and that's not going to happen. All that's going to do is give you paralysis, and you're going to go out there searching for the secret where there is no secret.
Yeah.
So you have to work on your mental game and understand that in this business, you're going to be wrong half the time. Number one. And number two, you can get lucky. All we need to do to find ourselves in a winning trade is just to learn how to click the mouse. But in order for you to be consistent, you have to understand that you're going to have losers, and you got to take them as they come. You predefine your risk, and then you move on to fight another day. Here's a question for you, Joe. Can you guys talk a little about strategies when it comes to selling and booking profits in momentum stocks? There are a number of times I ended up retaining 20% profits instead of 40%. How do you sell, Joe?
Well, I talked about the cup with handle pattern and even a double bottom. Those are very two common patterns. Statistically, when you break out of those, you will get about a 20% move before the stock meets some sort of a correction, sideways movement, or pullback. So, in the example, you say, I tend to grab 20% instead of I missed 40 on one. I say go with the statistics. Go with the statistics, because there's plenty of stocks I've sold with a 15, 20, 25% gain that have gone on huge. So it's okay. And to your point, I think that's a great point you make about, people feel like they always have to be right and they always have to maximize. I would rather hit a lot of singles and doubles,
right?
Because I accept I'm not going to be right. My numbers are somewhere, depending on if it's a good market, and 38, 44%, and again, just the basic concept is people don't think of this. You buy one stock and you make 20%, and you buy the next two and lose 7% on each. You're only right 33% of the time, and you've made money. Now, if you're a day trader, you have to adjust those numbers. I have a friend who day trades, and he's going for 3% upside, 1% stop, because he's day trading liquid names and he's very disciplined. He's going, but the whole point is, depending on your time frame, you want to try to keep it at a 3-to-1 ratio, 2.5 to 3. Paul Tudor Jones goes for 5. That's why he's, you know, he's a billionaire and one of the best ever. But you want to try to go for those types of ratios depending on your time frame. So for the person who's like, hey, I got 20, I could have got 40. I also traded Microsoft in the 90s, which I held on to that. I mean,
Right.
there's so many like shoulda, coulda, wouldas. But as a trader, I think you're better off being consistent with the statistics than trying to shoot for way too big of a game.
Right. And with that being said, I think for exits, you need clarity. You need to understand what it is that you're looking to get out of the market. And that you need clarity for that. Are you an investor or are you a trader? And I think it's a lot easier to find 10 to 15% winners than to find 2 stocks that are going to go up 100%. And people tend to forget that when you hold on for the long term, and there's nothing wrong with that, you are taking volatility risk, which means that you need to be able to hold on. If you want to hold for a year, you need to be able to have the fortitude to hold on, you know, through a 25% pullback.
Yeah.
And not many people can do that, because
Yeah.
even the biggest winners, whatever it is, I mean, you know, they have tremendous pullbacks. And if you can't withstand a 20% pullback, then what's going to end up happening is you're going to sell at the bottom for the most part. So you need clarity when it comes to exits. I am looking to get out of the market what it gives me within this little time frame right over here. For example, here's let me share
Real quick while you're saying that, I'm pulling up the Carl Icahn Netflix trade, you know, where I'm just sharing my weekly chart. I mean, look at these, you know, from 60 down to 50 something, and then up to 100, back down to 80. I mean, this is a lot of volatility. When he held it, again, split adjusted, whatever, when he made $2 billion off it and held it for 2 years, he sat through a lot of 35-40% corrections in the stock. So, and real quick, one thing you do great, Frank, is that, you know, to answer that question about a 20% gain that you wanted to ride into 40, one thing you do great is like, why not take off a piece at 20 and leave a piece to run?
Right, exactly. Let me share.
Go ahead, share your screen. Sorry, I just wanted to say that before I forgot.
Right, and this is Netflix. Here's where clarity comes in. So I get long the stock right over here, going through this, you know, down 3 days in a row, going through this high. And this is what I'm looking for my swing trades, this type of move here. I don't want to sit through this type of consolidation or pullback. And those numbers that Joe said, if you read IBD, they actually say that most growth stocks, they tend to stall out after a 20% gain, and you're better off taking that gain off the table because you don't want to sit through this consolidation. And as short-term swing traders, we are in the moving business. So what I'm looking to do is I want to get involved on the first day of a multi-day move. And then I want to take that money and get involved in another situation that's just getting started all over again. And I want to do that over and over and over again. Now, what I get within this burst is unknown. I don't know what we're going to get. A lot of it depends on what's going on in the market. So we're not going to get a 40% move when the market is melting down like it was in March.
Yeah.
So what goes on in the market, what's going on currently in the market, it's extremely important, because what happens is that we continue to trade the same way in every different market environments. And that's when we get disappointed and things are not working out the way they were working out, because things actually do change. And that's where, going back to my rolling 5-day watch list, that's when that helps. When I'm going through my watch and I'm saying, okay, stocks are petering out on day 3. Stocks are only going up for, you know, only a few percent, and then they're coming back down. I can adjust based on that, on a rolling 5-day watch list. But what's important is that you need to be, you have to adjust after a series of trades. You can't adjust on a trade by trade basis. And I think that's what a lot of people do. A lot of people go into, you know, their last trade was a loser, and then they don't take the next one because they think it's going to be a loser, or the last one it's a winner, and they're pretty much in euphoria. You know what I mean? So Joe, what happens? What do you do, Joe, after you bought 3 stocks and all 3 stopped you out at losses? What do you do?
It's never happened to me. What are you talking about? This is Twitter, sir. We don't lose. Oh, I've had a 10 out of 11 sometimes, and except the opposite of you shooting jump shots, where you making them all and I'm losing
Right.
them all. I mean, that is a great point, and my answer to that is that's usually telling me the market's not healthy. So if I have a series of losing trades, or I'm constantly getting stopped out, because kind of like how you're watching your rolling list, if I have a series of trades and if I have one loss, that's okay. I accept that, because after you do this for a while, it took me a long time. In 21 years, I honestly can say it took me 12 years to get over the shoulda, coulda, wouldas. And you might say, well, maybe I'm just slow and stubborn, whatever you want to call it. It takes some time to get over that. And now I just, one simple word, acceptance. I'm going to buy some stocks and I'm going to get stopped out. Sometimes that same day or the next day. It sucks, but I accept it. But it doesn't affect my confidence, or doesn't affect my psychology. But if I have a series where there's a lot of great setups and they're just consistently not working, that's usually telling me the market's not healthy.
Right.
And to your point, I'll either reduce size or just sit out completely. And on the flip side, when you're coming off of these lows and one after the other are working, I think I'm a decent stock picker, but I'm not that good. So
Right.
that's telling me, oh, snap, like this market's healthy. And then I might even step up my size, or, really, really try to take advantage of a good, healthy, maybe 6 to 12 week run in the markets that I believe the markets gives us every once in a while.
Right. How quick do you step up your size?
That's a great question. There's just so many of these that are just nuances.
Right.
If I have a little cushion and
And that's Joe, that's the reason why I'm asking. I know the answer, but I want people to know that there's a lot of things that are not so black and white.
I have so much trouble answering questions, because you know what the honest answer is? It's experience. And
Right.
I'm not being cocky. I'm not avoiding the question. I have honest, like, I just will tell you, I can't answer that so clearly, because it's experience and it's nuances of the markets that come from, tape reading and trading for so long.
Right. There's sometimes
Uh,
you just can't explain.
Yeah, I can't say, okay, I'm flat for the year. Now I'm up 5%. I have a cushion. I'm going to take bigger size. No, it's usually when not only are there a lot of stocks working out, but a lot of setups, and they're breaking out. They're breaking out on huge volume. They're holding their breakouts. They're not allowing you. You've had a great line, like strong stocks don't give you time to let you in. I think you said that. I'll give you credit anyways. But
Right.
but the point is that if things are really, really strong, that's when, when you're like, oh, I'm getting locked out of some stocks, I can't get in. Then I might step up my size. But again, there's just so many nuances, it's impossible to
And more
answer.
importantly, when it comes to size and risk, that's all relative. We're all different. So, Joe maybe is a risky guy. Joe, if we're playing basketball, he might pull up a half court. I would never do that. But that's but we're all
I'll pull
different.
up on half court 1-on-3.
Yeah, right. So we're all different. So when it comes to risk, you have to know yourself. Maybe 1% of my total capital risking in XYZ trade might be too much, but for you, it might be a walk in the park. So I think it's important to know what it is, know yourself and know what it is, whatever it is that I risk or Joe risk, or how quickly he starts to step up his size. It could be completely different for you. It might not work. One of the
Yeah.
issues that people have is that they go through a series of winning trades, and then when they finally increase the size, the market changes, and then they size up, and 2 trades, they'll lose the last 3 weeks worth of gains. So you have to do it slowly but surely, and do it
That's
at
a
a
great point.
level that's comfortable for you.
Yeah, I've always said you got to do what fits your personality and your style and your plan. And I hate to just give people tough love. If you don't have a plan, you better get one.
Right.
Because, you need to, well, what's my personality? What's my style? Well, you better define yourself. Like you said earlier, some people are okay day trading. I don't think my entries, I kind of like the example with Tesla. I'm like, okay, it's setting up, I'm not good enough to say, I don't know if it's going to go on this exact day. I kind of know it's getting ready, but it could take 2 or 3 weeks of a handle with a shakeout. So that's why I can't day trade, because I want to give things a little bit of room. And that's what you're encouraging people, especially in the beginning. Take a smaller position and give yourself some room. Now, other people don't have the personality, or they know their personality. Hey, I don't want to hold overnight. That's fine too. And God bless, do what works for you. But you need to define those rules based on your philosophy, your personality, what works for you, your risk tolerance, and all that stuff.
Right. And when you have a strategy based on whatever it is that you're reading, if you read a book and you like a strategy, you have to make it your own. And you also have to understand what are the flaws of that strategy. So that way, when things go sour, you know that's all part of the game. Um, and again, to reiterate, stop looking for something that doesn't exist. Every strategy, you're going to have losses. Those things are unavoidable. All you want to do is very simply accept them. You take a loss, you predefine your risk, you take it, and then you move on to the next trade.
Yeah. Let's take a couple more questions. Someone's asking, Frank, do you mainly focus on high momentum stocks, or give equal chance to all stocks that show up on your inside day or down 3 days in a row scan?
Right. So look, the inside day is an inside day is just a candle where um what matters is the context of the chart. Okay. Now, for those of you here, like here, inside day was right over here on 519, long 520, inside day through the high, inside day right over here as well. In a situation like Tesla, when I see a Tesla under this context, a volatile name, not volatile, but a stock that trades in a
It's
very
a high
wide
beta
range,
name. Yeah.
right? And it prints an inside day. That's important to me. That means something under this context. So an inside day, you can use it as a short setup and also as a long setup. What matters is the context of the chart. If I have an inside day where stock is up, 7,000 days in a row, and then it has an inside day, I want to short through that low. Under this context, I'm seeing an inside day like this, stock that's gone up from 400 to roughly 800. Like Joe said earlier, there's no interest in selling this stock. Stock made a 100% move, and people are still, maybe people are selling, but institutions are
But
there gobbling up the stock.
it's not as heavy as you would think. Yeah,
Right.
I get it. Yeah.
So then you see this, and you see this type of consolidation. And what that means, very simply, that whatever sellers are out there, they're gobbling up the stock. And then when you finally get that inside day, that usually means that the supply is pretty much gone. And coincidentally, what usually happens on those inside days to let you know the supply is gone is that you get very low volume. You get the contraction. Look at the volume here.
So it's a sign that the sellers are drying up.
Done. Right. They're done. Right here, drawing up here, 10 million shares. Right over here, 7.2 when the average 20-day volume is 14 million. So that's that. As far as the 3 days in a row scan, so I'm assuming that you are part of the Stocktwits room. The 3 days in a row scan, that's just something that's structural. In the short term, within my time frame, what matters the most is momentum and mean reversion. So typically when something is down multiple days in a row, unlike what we've read before in the past, if you look at the stats, the chances of that stock outperforming a week later are a little bit greater than the stock that's already up multiple days in a row. So you can Google that study, and that's widely known. But when I'm doing the 3 days in a row, I am waiting for a change of pattern. And the reason why is because 3 days can turn into 4 days, 4 days can turn into 5 days, and so on and so on. So I'm waiting for it to go to the previous day high.
Okay. Let's take one other question. It says for longer term holders, and maybe we can both answer this. So 6 to 12 months. So I love it. They define their time frame. Do you think mental stops are okay if you're tracking price and volume daily and have a cushion, or do you always have a stop on in the system?
Right. Go ahead, Joe.
I think mental stops are perfect for longer term, especially longer term. I love using the 50 days a guide or a close below the 10-week as maybe a stop. And that just gives you time to relax and possibly, like for example, an Amazon breaks out at 2000, it's at 24, 2500. You use a longer term hold. If you buy properly, and you say, let's say you think it's going to higher, you could use that 10-week as a close, and you could possibly hold that thing on for a lot longer. If you're using, that's my guide. I think that's a great question. Mental stops are perfectly okay for longer term. I don't think you need to have a stop in, but I don't know if you agree with that or not. Or
I would trust your mental stop because I know that you would take the stop and you're not going to look at the financials or change your view once a stock goes
or
down.
join a chat room on
Right.
Yahoo Chats and start
Yeah. Start pumping Amazon. Right. Yeah. So my recommendation is that if you're looking for a 6 to 12-month hold, my recommendation is you start with a wide stop. Right. So
But
here,
so you're making a good point. You'd be okay with putting it in if you don't trust yourself with the discipline to stick to the
right.
mental stop. That's a good
Right.
point. That's a
So
good point.
so here on Amazon, I'm gonna start. What's the 50-day? Let's just do here. 50-day is right over here. That's roughly 22%. I'm gonna start with a 25% trailing stop. And what that means is that as the stock starts to move higher, my trailing stop of 25% is going to increase with the price automatically. That's what I'm
Okay.
going to do. So hopefully those first couple of days, the first couple of weeks is where you're going to bear the most amount of risk. Because if the stock starts to move in your favor, that trailing stop will increase with the stock price. And every single day, your potential loss becomes smaller, smaller, and smaller.
Okay. And someone's asking wide stop but fewer shares. I think exactly right.
Yes. Again, you have to.
Because when you said put a 20% stop on something, some people might throw up and they say, there's no way I'm putting a 20% stop. But what's the difference if you got a 10% stop on a 2% position or a 20% stop on a 1% position? You're still risking 1% of capital.
Exactly. And again, this is what I recommend for new traders. I am perfectly fine with tight stops. And I understand that with tight stops, what's going to happen is that you might get stopped out within the noise. That's what happens. But I'm fine with that because I like the way it works out when it does work out. You have, for example, take a look at these quant funds that were up 4,000% when the market blew up. For 2 years, they were losing money. And all they do is take small losses over and over and over again, looking for that big payoff. The same thing with the guy the VIX 50-cent trader, buying the 50-cent VIX for a year, losing money, then suddenly he hits. But most people can't not take those amount of losses and continue to put on the trades on a consistent basis. If you can do that, if you can have 10 losers in a row and you can put the next one with no issues whatsoever, go ahead and start with a tight stop. But if you can't, my suggestion is you go with a wide stop.
Yeah, no, I think those are smart words. We've gone a little over an hour here. I think we can kind of wrap it up. I don't know if there's any other comments. Yeah, I mean, we really appreciate everyone for tuning in, and we'll record this and hopefully post this later on. And I hope to do more of these. I just love looking at charts and taking questions and trying to do our best to educate. I think it's important to build your confidence. And I think part of it is from being prepared, from doing the work. There's a lot of free screen. I mean, Frank and I we're professionals. We're using, TC2000 MarketSmith paid, things that we're using to, but there are free FinViz, things like that. There's ways to get started.
Right.
There's great ways.
Joe, what's your Twitter handle and your blog?
At jfahmy, and joefahmy.com is where you can find me. I blog up there. I have a lot of educational stuff. So, and tell people where they can find you. I know you have a room with Stock Twits.
They know who I am, Joe. You guys know Zor Traits on Twitter, and Stock Twits and Zor Capital, right?
Yeah, Zor Capital as well. Yeah, they can find both of us there. So
right, and Joe mentioned FinViz, which, by the way, for those when you're getting started, you don't have much capital to start spending on whatever it is, whether it's TC2000 or Marcus Smith, this thing gives you a lot of information.
It's a great resource. It's
Right.
a
It's a great,
great
I mean,
resource.
look, I mean, for if you're looking for what I told you guys about the top 100 names on a 3-month basis, 6 months, whatever, all you have to do is go to Screener, put average volume over whatever it is, 200,000. You go to stocks, price above, let's go above, above $3 a share, and then click on performance. And then all you have to do is quarterly performance. Take a look at the top 100 and look for contraction, tight patterns. Then you go to half a year, 6 months, same exact thing. And that's what you do.
Yeah, at least you got a strong list of some great growth names or great trending names.
Right.
Yeah.
Right. And if you, for some reason, you can also screen based on growth. You can screen based on volume, on
Oh,
whatever.
you can play around with that forever. Dividends, whatever
Right.
whatever your style is. Yeah. I think it's a great tool. And like I said, I just encourage people to start small, build your confidence, even with the number of shares, to start small, because this is all about longevity. I know we all want to get loaded, tomorrow, but I hope to be doing this for a long time, and I love doing this. And you just got to just slow and steady grow and continue to learn. It's 21 years doing this, and I think, Frank, you'd admit the same thing. We're still learning to this day.
You live to fight another day, and you're constantly learning.
Yeah,
Not
that's a
only
great.
about not only about the market, but about yourself.
Yeah, yeah, no, that's deep. That's a whole other conversation we could
Right.
get into some other time. So we got some great comments. People are saying, yeah, FinViz, TradingView, Thinkorswim are nice free platforms. So, and people are saying, thank you. So we appreciate you guys attending. We hope to do some more of these. And I'm signing out at Fahmy. So thank you. And Frank, if you want to close it out.
That's it, Joe. Thank you for your time, Joe.
No, thank you, man. Thanks for having me on.
And we'll see you guys on the stream, on Twitter, StockTwits, whatever. And hopefully we'll do this soon. Be well.
All right.